Hello and welcome to the latest Lunar Quarterly Update. The first quarter of 2024 has certainly been a strong one for equity markets, slightly weaker for bond markets. We've had news that the UK is technically in recession and we've seen inflation falling. So it's certainly been an interesting quarter for investment markets. They're the main talking points that we'll go through today. And I'm going to share my screen now and we can go through a quick presentation just to cover off all those points. So as we said, on the left-hand side here, you can see real GDP growth for the UK. This chart goes back to 2012. You can see the different components, which are the bars that make up GDP. You can see consumption, being that light blue one, is one of the main drivers to GDP growth. And that's because we're a consumption-led, service-driven economy. As you can't really see it, I mean, that really highlights the point that the UK technically entered recession at the end of last year because we had 2 quarters of negative growth. So that will be in the second half of last year. But as you can see from the chart on the left, it doesn't really register on a scale. It was such a minor and weak recession that we've gone through. On the right-hand side of this chart, it shows purchasing manager indices. What they are is they give you a really good indication of what's going on in the economy right now. GDP data tends to be announced with a bit of a lag, whereas the PMI data tends to come out a lot more quickly and give you a good idea of what's going on with the economy right now. And if you look, again, this is from 2012, you can see the services and manufacturing lines on there. A reading above 50 indicates the economy is growing. And what you can see in this chart is that the economy's really bounced back right at the end of that chart. Those lines have ticked up, meaning the economy's performing better. Services is the key one. As I mentioned, we're a service-led economy. Manufacturing is still technically in contraction, but has improved from the low levels that we were in the middle of last year. I think the other important point to make on this chart is on the left-hand side, and I mentioned it right at the beginning. This is real GDP growth. What real GDP growth is, it means it strips out the impact of inflation. But if you add back inflation, that's what we get nominal growth. Now, as we know, inflation's been running very high. So the economy did grow in nominal terms last year and has got bigger. And that matters for companies because companies work in a nominal world. They don't work in an after inflation environment, and not just companies, individuals. So the economy did grow last year. But when you strip out the impact of inflation, it did contract. And as I touched on, one of the key talking points that we've had over the last few years has been inflation. This is consumer price inflation going back to the beginning of 2021. You can see the slow increase that we went through, and then a very rapid increase towards the end, in the middle of that chart, where we had both the economy reopening from COVID, but then obviously the Russia invading Ukraine, which turbocharged different elements of the inflation. And you can see from this chart the different components as well. So you've got services in blue, core goods, food and alcohol, electricity and gas in that grey line, and then liquid fuels in that kind of limey colour. And as we move to the right of this chart, you can see that inflation has fallen away just as quickly, really, as it went up. You can see it has come down very quickly. And on the right-hand side of this chart, you can see electricity and gas and liquid fuels, they're actually deflationary, and they have been for the last year because energy prices and fuel prices have come down significantly. So in March, it was announced that the CPI figure was 3.4%, which is an amazing difference when we look at March of last year, when CPI was at 10.4%. So you've seen a 7% reduction in CPI over the last year, which has been a significant decrease in such a short period of time. But really, it shouldn't be as unexpected, and that's something we've been talking about with clients through the course of this year. And we expect inflation to continue to fall down and over the next few months hit the Bank of England 2% CPI target. And that matters because interest rates were increased significantly from 2021, as you can see at the far right of this chart, to the levels they are today at 5.25%. This chart goes all the way back to 2002 to show what interest rates have done. And we've purposely gone back to 2002 because we have had high interest rates in the past. We've just forgotten about them because we've been at low interest rates since the financial crisis in 2009. Now, just on interest rates, Our view, and it's widely expected by the market, is that interest rates have now peaked and that interest rates will fall probably from the summer. So June may be the first interest rate cut within the UK, but you can expect to see interest rates fall through the course of this year and potentially in coming years as well. I'd expect the Bank of England have got a neutral rate of interest rates of 3 to 3.5%. So that's where we should really be when all things are performing well. And as I touched on, the economy isn't in recession anymore. It was at the end of last year, but the growth in the economy is very weak. So when the Bank of England start to see inflation falling back to the target, then that removes one of the hurdles and the main reason why interest rates were increased so quickly over the last 2 years. The news that interest rates are going to be coming down was really reflected in the market at the end of last year in November and December. And they were very strong months for bond markets. But this quarter has been a slightly weaker month for bond markets. You can see here, this is just January, February, and March. You can see the gilts, so buying UK government bonds is that blue line. If you want to take a little bit more risk and buy corporate bonds, it's that kind of maroony line. But there are other bond markets out there, strategic and emerging market bonds that we can allocate to as well. And then they're yellow and green lines. But principally, we're talking about the blue and the kind of dark red line, the corporate bond index. And you can see that they've been slightly weaker in the first quarter. So why has that been the case? Well, at the end of last year and coming into this year, there was expectations that interest rates would be cut. But what's happened is that we've seen stronger economic data out globally, which has pushed back those expectations. If we go back to December, it was expected that the Federal Reserve could be cutting interest rates by as early as March. Now, clearly we're in April and that's not happened. So that's one of the reasons for the disappointment, that it's been pushed out. And the other is the magnitude of interest rate cuts as well. I think the market got very excited at Christmas, the bond market that is, and was pricing in 5 or 6 interest rate cuts in 2024. We didn't think that was the case. We disagreed with the market there. We feel like 2 or 3 is probably the most appropriate number that you'll see this year. And also on the view that we want to see inflation back towards a target, which would take us probably to the middle of the year. So what we did is we reduced our interest rate sensitivity within portfolios, which really helped protect the portfolios from interest rate increases and subsequently bond prices being under pressure. That's the bond market. What about the equity market? Well, it's been another very strong quarter to be investing in the equity market, unless you've been based in investing in China, which is that purple line, which is the only market that's delivered a negative return during a period. So you've got Japan, which has led the way, delivering quite a staggering 14% return during the quarter. The Nikkei 225 has also just hit an all-time high in the process. The S&P 500 has performed very strongly as well, with an 11.5% return. The NASDAQ, which is the technology index, has returned just under 10% at 9.6. It's also been a strong period for European investors as well, with the European equity market up 6.8, and the UK has lagged at 3.5% during the quarter. What's important, though, is to note is that the UK was actually the best performer in March. So most of the strong performance from the US and Japan came in January and February, and the UK has performed a lot better in March. Now, the reason markets have been so strong is because of the strong economic growth that we've been going through. Also, we're seeing this being spread out across companies. So it's through last year, there was the top 10 in the US or top 10 in the UK were really dominating the performance of major indices. But what's been really encouraging to see from our perspective is that that's been broadening out and other companies are starting to participate in this and share prices are being adjusted upward as well. It's a very encouraging sign to see such breadth within the market. That's certainly another positive to be taken from this. But what about looking forward? We told you about what's happened in the first quarter. What are we thinking about in the future? I mean, the first thing to mention is clearly we have elections going on at some point within the UK. We don't know when yet, but clearly there's a US election in November, and that's very much in our minds at the moment. It's not really something we can plan for too much. And we've looked at historic election cycles, and there's no great trend between which party's in power and the impact on the markets. But aside from elections, we have seen, as I've mentioned, 2024 has been a period where growth has surprised to the upside. So expectations are that growth will slow through the course of this year, but will still be positive. So we're going to not be in recession from a global or UK perspective. Inflation has fallen significantly already. As I mentioned, 10.4% last year to 3.4% in March. Inflation is likely to continue to fall as we go into the summer months, which should take some pressure off central banks, which means that interest rates have, in our view, likely peaked and will be cut later in the year. Markets, particularly the equity market, have had a very strong run, but they're not expensive, and sentiment has been very bad because of the market weakness in 2022. So we're still positive about the equity market. And if you're looking away from the equity market and looking at other asset classes, bond markets offer you attractive returns, some alternatives like property. A lot of bad news has been priced into those assets as well. So when we're constructing portfolios, we can see opportunities across all the different asset classes, equities, bonds, and alternatives, because of the starting valuation. And that's encouraging to us about delivering strong returns in the future. Just wanted to say thank you for your time today and listening to our quarterly update. If you do have any questions on this or anything else Luna related, please feel free to email us or give us a call at any point. We're always here to help. Thanks for your time today.